Most people think of a bank as a high-tech mattress. You hand over your money, they lock it in a giant vault, and it sits there until you ask for it back. In reality, a bank is a money middleman. The moment you deposit your cash, the bank immediately deploys it into loans, investments, or bonds. This creates the core profit engine of the entire banking system, net interest margin. If a bank pays you 3% interest on your deposit, but charges a borrower 9% for a loan, the bank pockets the 6% spread. Capturing that spread is the entire business of banking. To generate profit, a bank has to push deposited money out the door, rather than keeping it on hand. This creates an inherent tension. Banks promise that you can withdraw your money at any time, even though they lack the cash to pay every depositor at once. Under fractional reserve banking, if 100 people deposit 100 rupees each, the bank holds 10,000 rupees, but they might only keep 1,000 in cash, locking up the remaining 9,000 in long-term assets. This system assumes depositors won't all ask for their money on the same day. When that assumption fails and everyone demands their cash simultaneously, the bank collapses in a bank run. This structural weakness is known as a maturity mismatch. Depositors want access to their money instantly, but the bank has transformed those deposits into assets that are locked away for years. Every bank on earth operates on this timing gap. It is a standard feature of the industry that served as the hidden powder keg for Silicon Valley Bank. Usually, when a bank fails, it's because borrowers stopped repaying their loans. This is credit risk, the most common threat to financial stability. But Silicon Valley Bank didn't fail because of bad loans. They took billions in deposits and bought U.S. Treasury bonds and government-backed securities. These government bonds are considered some of the safest assets in existence. SVB had exceptionally low credit risk. With the safest assets in the financial world and no borrowers defaulting, the bank's destruction came from an entirely different direction. That force was interest rate risk. Bond markets operate on an inverse relationship. When interest rates rise, bond prices fall. For example, buying an older bond for 1,000 rupees, paying 2% interest, earns 20 rupees a year. If interest rates jump and new bonds pay 8%, they provide 80 rupees a year. To sell your old 2% bond, you must discount the price. Its market value drops from 1,000 towards 700 rupees. While the government guarantees the final payout years in the future, a spike in interest rates causes the bond's current liquid value to crash immediately. This math hit SVB the moment panicked depositors demanded their cash. Because of the maturity mismatch, SVB didn't have the cash on hand. They were forced to sell their safe long-term bonds ahead of schedule to pay back depositors. Since global interest rates skyrocketed, SVB had to sell those bonds at a massive discount, turning paper losses into billions of dollars in actual, unrecoverable losses. SVB avoided credit risk entirely, but they failed to account for interest rate risk, the reality that bond prices fall when rates rise. By holding safe assets but failing to manage the timing of their liabilities, SVB demonstrated that in banking, bad timing is exactly as lethal as bad investments. If you want to understand where the American technology industry actually lives, look here. And for decades, the financial engine powering that entire ecosystem operated out of this exact building, Silicon Valley Bank. This was a highly specialized operation. They catered directly to startups, tech companies, and venture capital firms. Nearly half of all U.S. venture-backed startups held their cash exclusively with SVB. While a standard national bank diversifies across agriculture, real estate, and retail, SVB tied its entire survival to a single, highly volatile sector. During the global economic response to COVID-19, the Federal Reserve dropped interest rates to near zero. That cheap money triggered a massive surge in venture capital funding, pouring historic amounts of cash into the startup sector. Those startups suddenly had millions of dollars on hand. And because of their tight integration with the tech world, practically all of that new cash was deposited straight into Silicon Valley Bank accounts. This chart shows how extreme that influx was. While normal banks saw their deposits grow by an average of 26% during this period, SVB's deposits shot up by 220%. Management suddenly held mountains of cash. To make a profit, a bank has to invest the money it holds. Now, SVB had to figure out where to put it all. Normally, a bank lends its deposits out as business loans, but SVB's clients were already swimming in venture capital cash, meaning there was almost no demand for new startup loans. To generate returns, SVB took that excess cash and bought heavily into long-term government bonds and mortgage-backed securities. This created a severe duration mismatch. On one side, they held short-term client deposits that could be withdrawn at any second. On the other side, they tied that money up in bonds, locked tight for many years. If clients suddenly need their money back, the cash pours out of the bank instantly, but the assets remain completely immovable, destroying the bank's liquidity. SVB traded their day-to-day liquidity for long-term yields, engineering a financial trap they could not escape if the market turned. In the United States, the government protects bank deposits through FDIC insurance, but strictly up to $250,000 per account. A standard retail depositor is fully covered. A startup CFO holding $50 million in a single account is entirely exposed. Because SVB catered almost entirely to heavily funded tech companies, roughly 90% of their deposits were totally uninsured. These founders and investors knew each other. They used the same WhatsApp groups, followed the same Twitter networks, and listened to the same venture capitalists. Massive uninsured exposure combined with instant digital communication meant a single rumor could spread through the client base in minutes. SVB had built a tinderbox. To understand how SVB kept this fragile structure hidden, you have to look at how banks use different accounting rules to manage the public perception of their health. This chart shows two security categories. In available for sale, banks report falling market values and take immediate losses. But under held to maturity, by promising not to sell, they ignore the dropping value. A $70 bond is officially claimed as $100. Held to maturity accounting doesn't fix a bank's balance sheet. It projects an illusion of solvency, letting an institution look perfectly healthy on paper while mathematically rotting from the inside. By 2022, Silicon Valley Bank relied heavily on this exact loophole, quietly building up an enormous held-to-maturity portfolio. SVB claimed this portfolio was worth $91 billion, but the actual market value of those assets had fallen to only $76 billion. That gap represented a staggering $15 billion hidden loss. To put that in perspective, SVB's total equity, the actual capital keeping them alive, was only $16 billion. If forced to acknowledge reality and sell those bonds, that single hidden loss would wipe out almost their entire survival capital, leaving them completely bankrupt. When a digital bank run finally forced SVB to sell those exact assets to cover withdrawals, the math was exposed to their terrified clients. Silicon Valley Bank collapsed because they engineered a lethal mismatch between their deposits and their investments. They buried that truth in accounting loopholes and were finally torn apart by the very tech network they had spent decades building. To combat post-COVID inflation, the U.S. Federal Reserve rapidly hiked interest rates from near zero up to 4.5%. As this climbs, it creates dual-strated pressure, hitting Silicon Valley Bank from both sides of its balance sheet simultaneously. The first strike hit their assets. When interest rates go up, the price of older, long-term bonds drops. SVB held a massive portfolio of these bonds, trapping them in billions of dollars of unrealized losses. The second strike hit their liabilities. High rates triggered a funding slowdown across the tech sector, forcing startups to burn through their existing cash and withdraw their deposits just to keep operating. SVB faced a structural conflict. They needed cash to pay fleeing depositors, but their liquidity was tied to bonds they couldn't sell without triggering immediate financial losses. This external pressure exposed a flaw in the bank's internal mechanics, specifically their net interest margin, the difference between what a bank earns on assets and pays on debts. This chart shows the squeeze. SVB was locked into earning a 1.5% interest rate on old COVID-era bonds, but to replace leaving cash, they borrowed emergency funds at 5%. These borrowing costs were effectively erasing their profit. The result was a significant drop in fourth-quarter profits. For anyone watching the balance sheet closely, this served as a clear warning sign. Silicon Valley Bank was struggling internally long before the public panic began, creating a volatile situation that only required a single catalyst to ignite. On March 8, 2023, the catalyst arrived. SVB made an unexpected midweek public announcement regarding its capital. They confirmed selling $21 billion in securities, realized a $1.8 billion loss and needed to raise emergency capital. In the professional investment world, a sudden public request for emergency capital is rarely viewed as a routine update. Markets interpreted the announcement as an admission that the bank's internal reserves had run dry. Major venture capitalists, including Peter Thiel's Founders Fund, immediately directed their portfolio companies to move all cash out of SVB. Because Silicon Valley is a highly networked ecosystem, that directive spread instantly. The localized concern for safety quickly turned into a widespread rush for the exit. Unlike the banking crises of the past, there were no physical lines of customers stretching down the street outside the bank's branches. Instead, customers opened banking apps and initiated transfers, moving billions of dollars instantly with a few taps on a screen. In a single day, depositors attempted to withdraw $42 billion from the bank. On March 10th, regulators stepped in to shut the bank down. SVB could not liquidate its assets fast enough to meet the demand for cash. Digital banking enabled withdrawals to move faster than the bank's ability to sell its assets, resulting in the second-largest bank collapse in U.S. history. To understand why Silicon Valley Bank was so uniquely vulnerable, we have to look at their approach to risk management. The core failure was a concept called the duration gap. Duration measures how sensitive a bond's price is to changes in interest rates. The longer the duration, the more the price falls when rates rise. This diagram shows the mismatch. SVB's assets were tied up in long-duration bonds averaging over 5.5 years, while their liabilities were short-term deposits that could be pulled at a moment's notice. It is like borrowing money that you must repay tomorrow, but locking that cash into a 10-year fixed deposit. If the lender asks for their money back, you have no way to pay them. The duration mismatch meant the bank's collapse was built into the balance sheet. This led analysts to a final verdict: a textbook failure of basic risk management. Look at the front doors of Silicon Valley Bank. To understand how a financial institution of this size collapsed, we have to start with a single internal assumption. In banking, there is a metric called deposit beta. It measures a specific behavior, exactly how much a bank decides to increase its interest rates for depositors when overall market rates go up. Historically, banks keep a wide margin here to boost profits. When the Federal Reserve hikes rates, banks usually don't pass those full hikes on to you. SVB's management looked at their specific client base, tech startups, and assumed they could keep their deposit rates extremely low. They believed their clients were so reliant on their specialized services that their deposits would remain stable even if they could earn higher yields somewhere else. This gauge illustrates the flaw in that logic. Depositor loyalty is conditional. SVB's clients had millions sitting in accounts far exceeding government insurance limits. During a crisis, uninsured money doesn't stay loyal. It snaps immediately into blind panic. Management built their business model on the idea that highly connected tech founders would patiently leave their cash in low-yielding accounts during a crisis. Misjudging that specific human behavior turned their balance sheet into a ticking time bomb. That internal mistake was compounded by an external loophole. In 2018, the U.S. government passed a series of law changes designed to weaken certain banking regulations. This graphic shows the new cutoff. Banks with less than $250 billion in assets were granted lighter supervision. SVB sat safely underneath at $209 billion. This exempted them from mandatory stress testing and strict requirements to maintain accessible, liquid cash. Without those guardrails, SVB utilized an accounting rule called held to maturity. This perfectly legal rule allows a bank to hide large, unrealized losses on their bond investments from public financial statements, as long as they promise to hold those bonds until they expire. Silicon Valley Bank was following the law. But by escaping strict supervision and using accounting veils to delay recognizing their losses, management lacked any mechanism to see the incoming economic shift. They had no safety net. We are used to historical images of bank runs, where panicked citizens physically stand in line outside a brick-and-mortar branch. The SVB collapse proved that modern capital flight is invisible, silent, and near instant. Once VCs saw balance sheet cracks, they instructed portfolio startups to pull funds. Billions left the bank in seconds, entirely through smartphone keystrokes. This terrified the government. They realized that thousands of startup companies would miss payroll within days. Worse, they feared psychological contagion. If the public saw one major bank suddenly die, the panic could trigger a nationwide wave of withdrawals. To stop the bleeding, federal authorities took an extraordinary step. They invoked a systemic risk exception, guaranteeing all deposits at SVB. They explicitly protected funds well above the standard $250,000 FDIC insurance limit. It is crucial to understand the math of this intervention. The depositors were protected. The bank's shareholders, however, lost their entire investment. Logistically, the FDIC created a temporary bridge bank to keep operations running and negotiated a deal for First Citizens Bank to purchase SVB's major assets. The intervention revealed a stark reality. The financial system used government guarantees to socialize the risk of a single, poorly managed private institution, simply to prevent the immediate freeze of the broader tech economy. When you strip away the dense accounting, this autopsy yields clear lessons. First, government bonds may carry near zero default risk, but they carry immense interest rate risk if you are forced to sell them early. Second, a bank that looks profitable on paper can still die overnight if it lacks the actual liquid cash to meet withdrawal demands. Third, concentration risk is fatal. SVB concentrated its entire client base in a single industry, utilizing a single type of depositor, all communicating within the exact same insular social network. When one panicked, they all panicked. Fourth, digital bank runs happen at light speed. Fifth, accounting tricks like held to maturity only temporarily delay reality. The actual market value of an asset always wins. And finally, ignoring risk management during an economic boom while assuming startup money will flow forever destroys institutions. The SVB failure was the logical consequence of ignoring fundamental financial realities during a period of easy money. This flowchart tracks the exact sequence of the disaster. It begins with the macro environment. Low interest rates during COVID triggered a boom in tech funding. That excess cash poured directly into SVB as billions in new deposits. Flush with cash, SVB made their fatal strategic move. They locked those deposits into long-term bonds. Almost immediately after, the Federal Reserve sharply raised interest rates to fight inflation. Because higher new rates make old, low-paying bonds less attractive, the value of SVB's bonds crashed. Simultaneously, the higher rates slowed down overall tech funding, forcing startups to burn through their existing cash and actively withdraw their deposits from SVB just to survive. Facing a cash shortage, SVB was forced to sell their devalued bonds at a loss. That triggered panic.
Venture capitalists directed an immediate mass exit, resulting in $42 billion being withdrawn in a single day. Each decision, viewed in isolation at the time, seemed rational to the people making them. But when their underlying assumption about depositor loyalty proved false, those decisions linked together to trigger an irreversible systemic collapse.